Hey everybody, and welcome back to H Invests. Today we're going to be talking about economic moats, one of Warren Buffett's most famous, tried and tested investment strategies. We're going to go through what an economic moat is, how to find an economic moat, and how you can apply these business concepts to help you make better investment decisions. I really hope you guys enjoy. Okay, so Warren Buffett and economic moats. So his quote on this was, "In business, I look for economic castles protected by unbreakable moats." So we'll go through that, the analogy behind that in a minute. I just wanted to quickly show you guys Warren Buffett's returns versus the S&P 500, just as a reminder. Here we are. Purple is Berkshire Hathaway, his parent company, and in green we have the S&P 500 aggregated top 500 companies by market cap in the US, and you can just see the difference. For anybody who thinks this graph isn't that impressive, note that the y-axis is in log form, so it goes 10, 100, 1000 compared to 100, 200, 300. If it was in linear form, it would look like this, with Warren Buffett's returns going up here and the S&P being flat. So that's why we've plotted it in log form. So yeah, $100 in Berkshire Hathaway in 1964, you'd be a millionaire by 2016. $100 in the S&P 500 in 1964, 2.5k, it's all right, you know, you've increased your money 25 times, but Warren Buffett has increased that return by 40 times, giving you $1 million instead of 2,500. So the point of going through this is that obviously everybody makes mistakes and nobody's perfect, but Warren Buffett has an incredible track record as an investor, and we should pay close attention to anything he says that is investment related. Okay, so what is an economic moat? So this comes from an ancient analogy. So historically, moats were built as a protective barrier around a castle. I'm from the UK. We have a lot of castles here. They're all over Europe and over a lot of medieval countries. It's basically just this load of water protecting a castle, protecting people from breaking into that castle and taking it over. And it's exactly the same thing with business. So in business terms, an economic moat is this competitive advantage that a company has, which prevents other companies from coming in and taking its market share. It's this moat around the business that gives it protection. These competitive advantages help businesses avoid a situation of perfect competition where you're competing on price alone. Your business strategy is very, very replicable, and effectively, you don't want to be losing market share to new entrants. And this is what the economic moat protects against. So I thought we'd look at supermarkets because it's interesting, because supermarkets, they do mainly compete on price. Most people, particularly if they're under a budget constraint, they will do their best to shop cheaply, right? Get food as cheap as possible so you can use your money in other areas. And it's interesting, in the UK, we've had a massive rise in budget supermarket growth. So Lidl and Aldi have come over from continental Europe, and they've really, really increased their market share in the UK supermarket. This is only data for 2017, but the trend is pretty consistent in the long run, and you can see that anecdotally just by traveling to different towns and seeing all the new Lidl and Aldis that have been putting up everywhere. So supermarkets typically don't have wide economic moats because people compete on price. They will go where it's cheaper. However, there is one type of economic moat called cost advantage that supermarkets can develop to help keep prices down. And this is what Lidl and Aldi have done. They've grown massively because they've used this economic moat, cost advantage, to drive their prices down. And as I mentioned, price is the most important factor when people go grocery shopping. So driving price down is not consistent across all types of economic moats, but it is with cost advantage. The way that Lidl and Aldi would do this is they have very, very efficient production mechanisms, very, very efficient business lines. And what they'll tend to do is they'll do the bare minimum, like as cheap as they can, as efficiently as they can, get the food there as cheap as possible. For example, if Tesco want, 50,000 biscuits, all different flavors, all different types, all different ranges, Aldi will go in and they'll say, oh, I'll go in and buy 100,000 of maybe the 2 or 3 most basic types of biscuit. And because Aldi are ordering much more in bulk, they will tend to get a cheaper unit cost. So Tesco, not ordering as many, might get a biscuit for 10p a unit. Aldi might go in and they might get it for 8p a unit. And then that allows that cost to be reflected in the lower cost of the consumer, and Aldi will still retain their margins. So that's the type of cost advantage that they are using. Okay, so how do we know if a company has an economic moat? This is going to be a very in-depth question, and basically I'm going to do a whole video series on this, so please keep posted for that. But for now, two rhetorical questions you want to be asking yourself. Number one, can the business raise prices without losing market share? So if it does raise prices 10%, are people just going to go elsewhere because price is the main factor? Or is there something else keeping the customers to that particular business? Number two, is it difficult for new entrants to come in and set up a competing business and erode that existing business's market share? So for example, in one of my recent videos, I was doing a full stock analysis on Lockheed Martin, an aerospace and defense company. In fact, I'd really recommend you guys watch it. It's on my channel. And the way that they work is they're aerospace and defense company. They sell and make fighter jets to the government. And to set up a business like that, it's very, very difficult because you have to have strong existing ties and good relationships with the government. You have to have a lot of capital expenditure, factories, metals, etc., to build these airplanes. And you also have to have a lot of money to pay the engineers to design these aircraft. So it's very, very difficult for new companies just to say, right, I want to be an aerospace and defense company. And hence what we see in that business is we see a lot of very mature companies that have been around for a long time in that space and not that many new entrants. If we contrast that with, say, setting up a coffee shop, if I wanted to go and set up a coffee shop down my local high street in the town, it'd be much, much easier for me to do that, right? Like, I might need to get a 20k loan from a bank. I'd need to hire a couple of staff on low wages, buy some coffee beans, some furniture, but I could get that set up and running for maybe 20, 30k and not that much time invested before we're actually making money. So that's what you've got to think about new entrants competing for the business. Aerospace and defense companies, very, very difficult. If it's something like a coffee shop, it's much, much easier. So I appreciate this is all very qualitative and subjective. So how do we try and quantify these decisions to make it easier? So there are many quantitative measures of this as well, and I'll go through all of them in subsequent videos, but two very, very key ones are operating profit margin and return on capital employed. So firstly, operating margin is operating profit over sales. That's effectively earnings before interest and tax over sales. Operating profit and EBIT are the same thing. And that's basically measuring how efficient is the business is getting its sales down that income statement into actual operating profit. So how many expenses does it have? Does it manage those expenses efficiently? And thus, if they are, then that will lead to higher margins because their EBIT will be higher relative to their sales. The other one, return on capital employed. Again, EBIT or operating profit on the top. And then on the bottom, you have capital employed, which is basically a measure of all the capital employed in the business. You've got shareholders' equity, and then so like the net asset that belongs to the shareholders. And then you've also got long-term liabilities, so the asset that belongs to the bondholders, right, that have lent the company money. And effectively, this measures how efficiently the business is using all of that capital employed in it to generate operating profit. If anybody's asking why it's just long-term liabilities, I think it's just because it's more accurate. Short-term liabilities can be, just for an emergency, or for example, a lot of companies took on short-term debt in the COVID pandemic just for a margin of safety, and it's not so much part of the core operating capital employed in the business. So those two, operating profit margin, return on capital employed, I very much recommend it. Obviously, the higher on those two, the more likelihood of prevalence of an economic moat. The other thing I wanted to talk about is Morningstar, a very reputable American research broker, and their kind of speciality is going through these economic moats. You've got cost advantages, which I talked about on the last slide, switching costs, intangibles, efficient scale, and network effect. Now, these are a lot to cover. I was considering putting it all in this video, but then I thought it'd be much better to break it down and actually do a deep valuation and do a deep analysis on each one properly. So what I'm going to be doing is there'll be a full series in economic moats. I'll be covering each one of these in depth so you guys can exactly see how to analyze them. I'll be giving company examples so you guys can work out whether a business has competitive advantage and hence is it a good company to fundamentally invest in. I really hope you guys enjoyed that video. Please give this a like and a subscribe if you found it useful. Keep posted for these subsequent video sessions. They'll be coming out soon. And for now, take care and happy